You paid the minimum, again, and somehow, the balance is higher than last month. You didn't go on vacation, you didn't buy anything crazy. You just lived, and the number went up anyway. If that's happened to you, you're not bad with money. You're not irresponsible. You are caught in a system that was specifically designed to keep you exactly where you are. And by the end of this video, you're going to understand exactly how that system works, and more importantly, how to get out of it. Let me introduce you to someone. Her name is Sarah. She's 34. She has a good job. She makes decent money, and she has $8,400 in credit card debt she cannot get rid of. Sarah doesn't remember exactly when it started. There was the car repair, then the medical bill, then a few months where work was slow, and the card was just there. Sound familiar? Because Sarah isn't one person. Sarah is 40% of American adults, carrying a balance on their credit card right now, today, and almost all of them are doing the same thing Sarah is doing, paying the minimum every month, telling themselves they'll pay more next month. Next month never comes, not because they don't want to, because the math is stacked against them in ways nobody ever explained. So today, we explain it from the beginning. No jargon, no judgment, just the numbers, the traps, and the way out. But first, I need you to understand something about how you got here, because it wasn't an accident, and it wasn't weakness. It was a Tuesday, or a Thursday, or a completely ordinary afternoon when something went wrong and you needed $400 you didn't have. The refrigerator broke, the tire blew, the dentist called, and you did what 60% of Americans would do in that exact moment. You put it on the card. That decision wasn't wrong. That was survival. The problem came later, with the statement, when you looked at the minimum payment, $35, and thought, okay, I can do $35. I'll pay more next month. That $35 decision, that one number, is the beginning of everything we're going to talk about today. Because $35 feels responsible. $35 feels like you're handling it, and that feeling is exactly what the system is counting on. So let's start with the number that changes everything, the number that almost nobody knows. And once you see it, you cannot unsee it. Sarah has $5,000 on her credit card. The interest rate is 20%. She pays the minimum every month. How long does it take to pay it off? Not 2 years. Not 5 years. 17 years. And in that time, she will pay back over $12,000 on a $5,000 debt. That extra $7,000? That's not a fine. That's not a fee. That's the price of only paying the minimum, every single month. And here's the part that makes this even harder to accept. The bank knows this number. They calculate it before they mail you the card. In fact, since 2010, they're legally required to show you this number on your statement. It's called the minimum payment warning. It's in tiny print at the bottom, and almost nobody reads it. Go find your last statement right now. It's there. It's been there the whole time, and it probably says something that will make your stomach drop. Now, most people understand that credit cards charge interest. What most people don't understand is how that interest actually works, and this is where it gets interesting. You think your 20% interest rate is charged once a year. It's not. It's charged every single day. Your annual rate is divided by 365. That gives you your daily rate. On a 20% card, that's 0.055% every day on your entire balance. So if you have $5,000 on that card, you're being charged roughly $2.74 today, while you sleep, while you work, while you do everything right. That's $19 this week, $82 this month. Almost $1,000 this year, just sitting there, just existing. Now here's something that almost nobody knows, and I want you to pay close attention, because this one costs people thousands of dollars. Before we continue, if you enjoyed the video, please don't forget to like and subscribe. Every like and subscribe matters and helps us to grow. Most credit cards have what's called a grace period. That's the window between your purchase and when interest starts, usually about 21 days. And most people think they have this, always. They don't. The grace period only exists if your previous balance was zero. The moment you carry even $1 of debt, the grace period disappears completely, which means the month you couldn't pay your full balance, every new purchase you made that month started collecting interest immediately. From day one, you bought groceries. Interest started that day. You filled up your gas tank. Interest started that day. Every single transaction, running interest from the moment it posted. This is why people say, I paid my bill every month, but the balance never went down, because they weren't starting from zero. They just didn't know it. Okay, now you know the daily interest. You know the grace period trap. Let me show you one more thing that most people get completely wrong about their credit card. When you make a payment, where does that money actually go first? Most people assume it goes toward their newest purchases. It doesn't. By law, your payment goes toward the highest interest balance first. Which sounds fair, but here's what that actually means in practice. If you have a balance transfer at 0% and regular purchases at 20%, your payment hits the 20% balance first. The 0% balance just sits there, untouched, and the balance transfer fee, that's usually 3 to 5%, charged the moment you transfer. So a $5,000 balance transfer has an upfront cost of $150 to $250 before you've paid a single dollar of interest. Most people don't factor that in when they're calculating whether a transfer makes sense. Now I want to stop here for a second, because I know what some of you are thinking. Lois, I know all this. I just don't have the money to pay more. And that's real. That's a real constraint. But here's what I've found. Most people who say they can't pay more actually can. Not a lot more, but enough. And enough is all it takes to change the math completely. Let me show you what I mean. Sarah pays $100 a month instead of $35, just $65 more. That 17-year payoff, it drops to 4 years. The $12,000 she would have paid, it drops to $6,800, $65 a month. One less dinner out, one canceled subscription. That's the difference between 17 years and 4, between $12,000 and $6,800. Okay, now we get to the part of this video that most financial channels don't talk about, because it's uncomfortable, and because it makes the credit card companies look very bad. Here's a word you've never heard a bank use, but it's real, it's documented, and it's the word they use internally to describe their best customers. The word is deadbeat. And in the credit card industry, a deadbeat is someone who pays their balance in full every month. That's it. That's the insult. Because someone who pays in full every month costs the bank money. They get the rewards, they get the fraud protection, they get the float, and they pay zero interest. The bank makes almost nothing from them. The customers banks actually want, they have a different name for those too. They're called revolvers. People who carry a balance, month after month, paying interest, forever. That's the customer banks design their entire business model around. The rewards points, the cashback, the sign-up bonuses, all of it, funded almost entirely by the interest paid by revolvers. You are either paying for those rewards, or you are the reason someone else gets them. Now, knowing this doesn't change your interest rate, but it changes something more important. It changes how you see the game you're playing, and you cannot win a game you don't understand. Let's talk about something else nobody explains clearly. Your credit score. Most people think a higher score means they're better with money. That's not exactly right. Your credit score doesn't measure how good you are with money. It measures how profitable you are for lenders. Those are two very different things. Someone who has never borrowed a dollar in their life has a terrible credit score. Someone who has borrowed hundreds of thousands of dollars and made every minimum payment on time has an excellent one. The system rewards participation in debt, not avoidance of it. Keep that in mind every time someone tells you to build your credit. Now here's one that I think about every time I look at a credit card statement, and I want you to really sit with this one. When you swipe your credit card, you feel like you're spending money. You're not. You're borrowing money that doesn't exist yet, and promising to pay it back with money you haven't earned yet. Research shows that people spend an average of 12 to 18% more when paying with a credit card versus cash. Because the pain of payment is delayed. The brain doesn't register the loss in the same way. This isn't weakness. This is neuroscience. The part of your brain that responds to financial loss, the insula, is simply less activated when you swipe than when you hand over cash. Credit card companies know this. They've known it for decades. It's why the card is designed to be frictionless. Tap. Gone. No wait, no paper, no moment of hesitation. Now let's talk about something that trips up millions of people, and it involves a number that has nothing to do with how much money you have. Your credit utilization ratio. This is the percentage of your available credit that you're currently using. and it has an enormous impact on your credit score, more than most people realize. The general rule is keep it below 30%. But here's what nobody tells you. The people with the highest credit scores, they keep it below 10%. Some even below 5%. And here's the trap. Your utilization is calculated based on the balance reported to the credit bureaus, not based on what you actually owe, not based on your statement, based on what the bank reports, which happens on a specific day each month. Which means you could pay your full balance on the due date, like clockwork, and still have high utilization reported, because the bank reported your balance before your payment posted. The fix is simple once you know it. Pay your balance a few days before your statement closing date, not the due date. That's when the balance gets reported. Pay before that, and you control what the bureaus see. Most people have never heard of a statement closing date. Most people only know the due date. 2 different dates, very different consequences. Now, let's talk about something that sounds like a lifeline, but for many people, becomes a longer chain. Debt consolidation loans. The pitch is simple, and it sounds great. Take all your high-interest credit card debt, roll it into one loan at a lower rate, make one payment, pay less interest. And sometimes, it works exactly like that. But here's the number that tells a different story. Over 70% of people who consolidate their credit card debt have that same amount of credit card debt again within 2 years. Because consolidation solves the symptom. It doesn't address the behavior. The cards are still open, the limits are still there, and now there's breathing room, which often gets filled. The debt consolidation industry knows this. It's good for business. You pay off the cards, you feel relief, you spend again, you consolidate again. The cycle continues, just with different labels. Now, here's the one that I promised. The one about time, and the law, and a mistake that costs people thousands of dollars because nobody told them the rule. Every debt has a statute of limitations, a time limit after which the creditor can no longer sue you to collect. Depending on your state, that's usually between 3 and 6 years. After that window closes, the debt still exists. It still affects your credit report for up to 7 years. But they cannot take you to court. They cannot get a judgment. They cannot garnish your wages. Here's where it gets dangerous. When a debt passes its statute of limitations, collection agencies still call, still send letters, still try to collect, and they will say anything to get you to make a payment. Because the moment you make any payment on a time-barred debt, even $1, the clock resets completely. You have just legally restarted the statute of limitations, and they can sue you again. This is not an accident. Collection agencies train their agents specifically on how to get you to make that first small payment. Can you do anything today? Even just $10? That $10 could cost you thousands. If you ever get a call about an old debt, before you say anything, before you confirm any information, before you make any payment, you need to know the date of your last payment on that account. That date is everything. Okay, you now know things about credit card debt that most people, including many financial advisors, don't fully understand. Now let's talk about getting out. And I'm going to be honest with you about something first. There is no hack. There is no secret trick. Anyone selling you a magic solution to debt is either uninformed or selling something. The way out is a system, and the system works if you work it. Step 1. Before you do anything else, is to know your exact numbers. Not a rough idea. Exact. Every card, every balance, every interest rate, written down in one place. Most people in debt don't know their exact total. They have a feeling, a dread, a number they don't want to look at. But you cannot defeat an enemy you refuse to see. Go to annualcreditreport.com. Pull your free credit report. Every account, every balance, every creditor. It's free, it's legal, and it might show you accounts you forgot you had. Once you have your numbers, you need a method. And this is where I want to tell you about 2 different approaches, because the right one for you depends on who you are, not what the math says. Method 1, the avalanche. You line up your debts from highest interest rate to lowest. You pay minimums on everything, and you throw every extra dollar at the highest rate card first. Mathematically, avalanche is the winner. It costs you the least money over time. If you stick to it, you pay less interest than any other approach. Period. Method 2, the snowball. You line up your debts from smallest balance to largest, regardless of interest rate. You pay minimums everywhere and attack the smallest balance first. Mathematically, snowball costs more. You'll pay slightly more interest overall. But here's what the research actually shows, and this surprised even me when I first read it. People who use the snowball method are significantly more likely to become completely debt-free because they see wins early. They pay off that $400 card, then the $800 card, and the momentum is real. The best debt payoff method is the one you actually finish. A perfect plan you abandon is worth nothing. An imperfect plan you complete changes your life. Know which one you are. Now, let's talk about something that can accelerate either method significantly, and it costs nothing to ask for. Call your credit card company. Ask for a lower interest rate. That's it. Just ask. If you've been a customer for more than a year and have a decent payment history, there's roughly a 70% chance they'll say yes. The exact words, "I've been a customer for X years, I've been paying on time, I've seen offers from other cards at lower rates. Is there anything you can do for my rate?" That's the script. It works. Even a 2 or 3% reduction in your interest rate on a $5,000 balance saves you hundreds of dollars and months of payments for a 3-minute phone call. If they say no, ask when you can ask again. Ask what you'd need to do to qualify. Get information, then call back in 3 months. Persistence here is not rude. It's smart. Now let's talk about the hardest part of getting out of debt. And it's not the math. It's not the interest rate. It's the month when everything goes wrong. And it will. The car breaks down, the medical bill arrives, the hours get cut, and suddenly the $200 extra you were putting toward your debt needs to go somewhere else. This month. Most people treat this as failure. They feel like they've ruined the plan. They stop, and they don't restart for months. Sometimes they never restart. Here is what actually separates people who get out of debt from people who don't. It's not intelligence, it's not income, it's what happens in the month after the bad month. If you can restart, even with half the amount, even with a smaller payment than before, you will get there. Missing 1 month is not failure. Stopping is failure. There is a difference. Now, if your debt situation is more serious, if we're talking about collections, or lawsuits, or wages being garnished, I want to talk to you directly for a moment. You have more rights than you know. The Fair Debt Collection Practices Act gives you specific legal protections. Collectors cannot call before 8 a.m. or after 9 p.m., cannot call your workplace if you've asked them not to, cannot use abusive language, cannot lie about what they can do, and you can send a written cease communication letter. Once they receive it, by law, they can only contact you one more time to confirm they've received the letter. That's it. After that, silence. Does that eliminate the debt? No, but it stops the harassment while you figure out your next move. And having space to think clearly is worth something. If a debt has gone to court and a judgment has been entered against you, that is serious, and you need an actual attorney, not a YouTube video. Many nonprofit credit counseling agencies offer free consultations. The NFCC, National Foundation for Credit Counseling, is a good place to start. For everyone else, for the majority of people watching this who are dealing with credit card debt they want to pay off, not escape, let me leave you with 3 things to do this week. Not next month, this week. 1. Pull your free credit report at annualcreditreport.com. Write down every balance and every interest rate. Know your exact number. Today. 2. Call your highest interest card. Ask for a rate reduction. Use the script I gave you. It takes 3 minutes. It costs nothing, and it might save you hundreds of dollars. 3. Pick a method, avalanche or snowball, and make 1 extra payment this week. Not a big one. Whatever you can. $20, $50. The amount matters less than the decision to start. Sarah. Remember Sarah? She started with $8,400. She called her card, got her rate dropped from 22 to 17%. She chose Snowball. She's been at it for 11 months. Her balance is now $5,900. She's not done, but she's moving. And moving in the right direction with a system is how this ends. Not with a magic trick, not with a lottery win. With a decision made once, renewed every month. Here's what I want you to take from today. The debt is not a character flaw. The system was designed, deliberately, expensively, by very smart people to be hard to get out of. The minimum payment, the daily interest, the grace period that disappears, the deadbeat label, the utilization trap, the statute of limitations reset. None of that was in the fine print you read before you signed. But now, you know. And knowing is the first move, the only move that unlocks every other move. I want to hear from you. Drop your debt payoff method in the comments. Avalanche, snowball, or something else entirely. And if you're just starting, drop a 0. No judgment, just community. That's everything for today. Take one of these ideas and actually use it this week. That's where it counts. If this was worth your time, the like button is right there. And if you want to keep thinking this clearly about money, subscribe. I'll see you in the next one.